Have you ever wondered what it would look like if the global financial system tried to warn us before it broke? Not after the panic, not after the headlines, but before the world realizes something is already cracking beneath the surface. Because right now, that signal is not just flashing, it's screaming. There is a single indicator in finance that has appeared before nearly every major economic disaster of the last 100 years. It showed up before the Great Depression in 1929, before the dot-com crash in 2000, before the global financial crisis in 2008, and it is active again today. But this time, it is more extreme than anything we've seen in modern history. It's called the yield curve inversion, a simple line on a chart that has predicted every major recession for an entire century with near-perfect accuracy. If you want to stay ahead of the next phase, not just react to it, subscribe. Because this channel isn't here to hype the crash, it's here to prepare you for the world after it. Economists argue about many things, but this is not one of them. The inverted yield curve is the most reliable recession signal ever recorded. But here's the part nobody is ready for. This inversion is not normal. It is deeper. It is lasting longer. And it is happening at a time when the global economy is built on more debt, more leverage, and more artificial confidence than ever before. Which means if history rhymes again, the crash that follows won't just repeat 1929 or 2008. It could rewrite the economic chapter of this century. Yet, just like every time before, most people don't feel any danger. Stocks are rising. Jobs look stable. The average person thinks, if something was wrong, we'd already see it. But that is the trap. The yield curve doesn't warn you after the crisis begins. It warns you in the calm before the storm, when everything still looks safe, when optimism is at its peak, and when people assume this time is different. And every time humanity has ignored that signal, the price was paid in panic unemployment bankruptcies and shattered illusions. So before we understand the danger in front of us, we need to understand the pattern behind us. The moments in history where the same warning appeared, and everyone chose not to listen. Because the future always hides in the past. To understand why the yield curve matters, we have to go back almost a century, to a time when the world was convinced that prosperity had no limits. The late 1920s were called the Roaring Twenties. The economy was booming. Technology was advancing. Cities were growing. People were buying cars, radios, refrigerators, and most importantly, stocks. Newspapers wrote that humanity had entered a permanent era of wealth. Economists said recessions were a thing of the past. Even the U.S. president at the time, Herbert Hoover, declared that we are nearer to the final triumph over poverty than ever before. But behind all the optimism, something quiet and invisible to the public had already changed. In 1928, the yield curve inverted. Short-term interest rates suddenly rose above long-term rates. That might sound technical, but its meaning is brutally simple. It meant money was getting tight, credit was drying up, and the financial system was bracing for something the public could not see. Imagine charging someone more interest for a 3-month loan than for a 10-year loan. It makes no sense, unless banks and investors believe that the near future is far more dangerous than the distant future. That single shift, that upside-down interest rate curve, was the first warning. But nobody listened. Stocks didn't fall. In fact, after the inversion, the market kept rising for almost 2 more years. The Dow Jones jumped nearly 50% after the warning signal went off. People looked at the rising market and said what we always say before a collapse. If things were really bad, we'd see it by now. But the yield curve wasn't predicting the present. It was foreshadowing the impact of something building underneath. Tightening money, rising debt, and an economy held up by confidence instead of reality. Then came October 1929. The illusion shattered. The stock market collapsed by nearly 90%. Banks failed. Factories shut down. Unemployment hit 24%. Families lost everything. Not because they weren't warned, but because they ignored the warning. The tragic lesson of 1929 was not that disasters happen suddenly. It was that the danger always appears long before the damage. And history was about to repeat that lesson again and again in the decades that followed. 7 decades after the Great Depression, the world found a new reason to believe in unlimited prosperity: the Internet. If the patterns in this video already make sense to you, hit the like button and subscribe, not for the algorithm, but to tell YouTube this is the kind of truth people should actually see. The late 1990s were a modern gold rush. Tech startups were turning teenagers into millionaires. Investors didn't care about profit, only potential. Companies with no revenue were valued higher than century-old corporations. People quit their jobs to day trade from home. Wall Street said a new economy had begun, one where technology would prevent recessions forever. But just like in 1928, behind the celebrations, the yield curve inverted in the year 2000. And once again, the pattern repeated. The signal appeared. The public ignored it. The markets kept rising anyway. The National Association of Securities Dealers Automated Quotations, the center of the tech boom, surged more than 60% after the inversion. Investors laughed at economists who warned of a collapse. Magazines ran covers titled Dow 36,000 and The Death of the Business Cycle. Sound familiar? Every time humanity thinks it has conquered economic cycles, the cycle reminds us who's in control. Because the yield curve wasn't T reacting to hype, it was reacting to reality. Corporate debt was exploding. Venture capital was pouring money into companies with zero profits. Stock valuations hit levels not seen since 1929. And interest rates were rising, slowly suffocating the bubble. Then, just months after the inversion, the dot-com bubble burst. The National Association of Securities Dealers Automated Quotations didn't just correct. It collapsed by 78%. Billions of dollars vanished. Half of all tech startups disappeared. Retirement accounts were wiped out. The new economic era died almost overnight. And still, the lesson was not learned, because only 6 years later, the yield curve inverted again. And this time, the world was convinced that housing, not tech, had become the unstoppable engine of wealth. Which brings us to the most famous crash of modern history. The warning came again. The world ignored it again. And the price was even higher than before. By the mid-2000s, the world had a new obsession: real estate. The story was simple, seductive, and everywhere. Housing prices never fall. You can't lose money on property. If you don't buy now, you'll never afford a home again. Banks were offering mortgages to anyone with a pulse. People were buying multiple homes they couldn't afford, not to live in, but to flip for profit. Financial institutions were slicing bad loans into HQA-rated products and selling them worldwide. TV shows glamorized house flipping. Taxi drivers, students, and waiters bragged about owning investment properties. The entire economy, not just the market, was living in a bubble. And then, just like before the Great Depression, just like before the dot-com collapse, the yield curve inverted in 2006. Once again, the same warning light flashed. Once again, the same response followed. This time is different. The economy is strong. Unemployment is low. The experts are wrong. And just like in 1929 and 2000, the market kept rising after the signal. The S&P 500 gained nearly 20% after the inversion. Housing prices kept climbing. Banks kept lending. People kept borrowing. All while the most accurate recession indicator in history was quietly telling the truth. The system is under stress. The foundation is cracking. The clock is running. Then the illusion burst. In 2008, the global financial system collapsed. Not slowly, but violently. Banks failed. Lehman Brothers disappeared. Millions of people lost their homes. Trillions of dollars evaporated from the world economy. The word recession was replaced by a darker one: crisis. And when economists looked backward, the pattern was undeniable. Yield curve inverted 2006. Market kept rising 2006, 2007. Crash 2008. Just like 1929. Just like 2000. 3 times in history, the same signal warned us. 3 times, people ignored it. 3 times, the cost was catastrophic. So here's the question. What happens when the same signal flashes again, but deeper, longer, and more extreme than any time before? Because that is exactly what happened in 2022. And this time, it's not just the US at risk, it's the entire global financial system. In August 2022, the same signal that warned the world in 1928, 2000, and 2006 returned. But this time, something was different. Something no economist alive today has ever seen before. The yield curve didn't just invert, it collapsed. It sank deeper than it did before the Great Depression, deeper than before the dot-com crash, deeper than before the 2008 financial meltdown. And it has stayed inverted longer than at any point in the past century. That means one thing. The warning is no longer temporary. It is structural. And yet, just like before every collapse in history, the surface looks calm. Stocks are rising. Unemployment is near record lows. Corporate profits still look strong. Politicians are claiming the economy is resilient. And the average person is convinced nothing is wrong. It is the exact same illusion we saw in 1928, 2000, and 2006. If a crisis was coming, we'd already see it. But the yield curve doesn't measure the present. It measures the pressure building beneath the present. And today's pressure is unlike anything the world has ever faced, because this time, the world is drowning in far more debt than before any previous recession. Governments, corporations, and households are all leveraged at the same time. Interest rates have risen at the fastest pace in 40 years. The cost of borrowing has doubled or tripled in less than 2 years. Savings that protected consumers after COVID are almost gone. In 1929, households were barely leveraged. In 2000, debt was mostly in the stock market. In 2008, the damage was concentrated in housing. But today, debt is everywhere. Mortgages, student loans, auto loans, credit cards, corporate bonds, government deficits. Every part of the global economy has been built on borrowed money at low interest rates that no longer exist. And when borrowing costs stay high long enough, something always snaps. A family stops spending. A company lays off workers. A bank freezes credit. A government prints money, or defaults. Not because of fear, but because of math. That is what the yield curve is showing us, the exact moment where the math stops working. And here's the most dangerous part. In past cycles, yield curve inversions were followed by recessions in 12 to 18 months. 1928 inversion, 1929 crash, 2000 inversion, 2001 crash, 2006 inversion, 2008 crash. If that timeline repeats, then the moment of impact is now, not years away. But this time, it's not just a market crash at risk. Because the world is more interconnected, more digital, and more leveraged than ever, the next crisis may not just hit banks or stocks. It may trigger a reset of the entire financial architecture, from interest rates to currencies to the way money itself works. And while most people are looking at the stock market for clues, the bond market, the oldest, most conservative, least emotional part of finance, is already screaming. Something is breaking, and it will not stay hidden much longer. And now, we arrive in our time. Not history, not theory, not a story told in past tense, but the moment you are living in, right now. Because the yield curve has inverted again. Not briefly, not slightly, but deeper and longer than any inversion in 40-plus years. The U.S. 2-year versus 10-year Treasury spread has been negative for over 18 months, the longest inversion since the early 1980s. In 2023, at the peak, the inversion reached 108 basis points. The sharpest drop since Paul Volcker was fighting inflation with 20% interest rates. Every recession since 1955, all of them, followed an inversion. There has never been a case where the yield curve stayed inverted this long, and the world simply skipped a recession. Not once, not ever. So, if the alarm is ringing, why isn't the world panicking? Because this time, the denial is stronger and more dangerous than ever before. Here's what people are saying today. The economy is too strong. No recession is coming. Unemployment is low. That means we're safe. Tech stocks will save everything. The Fed will lower rates before anything breaks. Sound familiar? It's exactly what they said in 1929, in 2000, in 2006, in 2019. Every time, the crowd believed this time is different. Every time, the crowd was wrong. This time, we are not dealing with one bubble, but multiple. Record high corporate debt, bigger than 2008. Record high government debt, bigger than World War II levels. Record high credit card debt, over 1.3 trillion. Real estate prices still inflated despite rising mortgage rates. Stock market concentration, 7 companies making up 30% of the S&P 500. AI investor hype cycle, déjà vu of the dot-com era. Banks still holding long-duration losses from 2020-21 low-rate era. Commercial real estate vacancies hitting all-time highs. Consumer savings rate back to 2005 levels, right before the crash. It's not one fuse waiting to blow. It's a network of fuses already burning. And the yield curve isn't predicting a small correction. It's predicting a structural reset. History suggests a sequence. Inversion already happened. Lag period. The world relaxes. Markets rise. People forget. Something breaks. A bank. A market sector. A debt chain. Recession begins, suddenly, then all at once. We are in stage 2 right now. The stage where people mock the warning. Where stocks rally into the storm. Where confidence is loud and risk is silent. But the clock has already started. The yield curve doesn't tell you the day it breaks. It tells you the break is unavoidable. If the yield curve has called every recession for 70+ years, why is the world more interested in predicting when interest rates will go down instead of asking, what is the curve trying to warn us about this time? Why humanity keeps ignoring the same signal? If the yield curve has predicted every major recession for nearly a century, if it warned us before 1929, 2000, 2008, and 2020, if it is flashing the same warning right now, then the real question is no longer economic. It's psychological. Why do people ignore the same signal over and over again? Why does history repeat, even when the facts are visible in advance? The answer is simple. Humans don't live in reality. They live in narratives. We believe what everyone else believes. If the stock market is rising, if companies are hiring, if the news is calm, people assume the future will repeat the present, even when data disagrees. In 2007, 70% of Americans believed housing prices would never fall. In 1999, people believed profits didn't matter. In 1929, newspapers printed headlines like "The End of Poverty." Crowds don't think, crowds feel, and feelings are not data. Humans want to believe someone is in charge. The Fed, the government, technology, the smart people on TV. But history shows something uncomfortable. The Fed raised rates into the 1929 crash. The Fed said subprime was contained in 2007. The Fed said inflation was transitory in 2021. The Fed said soft landing is likely in 2023, while the curve was deeply inverted. The greatest illusion of modern economics is that leaders are steering the system. Most of the time, they're reacting after the damage is done. We remember 3 years back. Markets remember 3 months back. Politicians remember until the next election. But the yield curve remembers 70+ years back. That's why it sees what humans don't. Every generation thinks it is smarter than the last. Every generation thinks it has new tools and new knowledge. But every generation walks into the same wall, just from a different direction. People don't just want things to go well. They need to believe it. Optimism is emotionally profitable. Pessimism is socially expensive. You get likes for saying, AI will change the world. You get ignored for saying, debt levels are unsustainable. Hope is a drug, and it sells better than truth. We mistake delay for safety. Every time the yield curve inverts, there is a lag. Sometimes 6 months, sometimes 18 months. During that window, the world relaxes. Stocks rise again. People say, see, nothing happened. And then, suddenly, it happens. Because the yield curve doesn't predict when the storm hits. It predicts that the storm is already forming. So, what now? The yield curve isn't a headline. It's not a prediction. It is a diagnosis. It doesn't say, panic now. It says, prepare now, because panic will come later. And the people who survive economic resets are not the loudest. They are the ones who listen while everyone else is distracted. The real danger is not recession. The real danger is believing this time is different. Because the most expensive sentence in all of financial history is, don't worry, it's not like last time. But the yield curve whispers the truth. It is always like last time, just with different actors. We began this journey in 1929. We traveled through 2000. We relived 2008. We felt the shock of 2020. And we arrived in the present, where the same signal is flashing again. Across 4 generations, 4 bubbles, 4 crashes, one pattern has remained unchanged. The yield curve warns first. The world listens last. And every time, the cost of ignoring it has grown. What the past really taught us. 1929. We learned that belief is not a shield against math. 2000. We learned that technology cannot cancel economic gravity. 2008, we learned that debt is not wealth until it explodes. 2020, we learned that the system is more fragile than it pretends to be. And now, we're about to learn whether the longest inversion in modern history is a false alarm, or the most important warning of our lifetime. The yield curve doesn't predict the future. It reveals the future that has already begun. It doesn't care about the stock market. It doesn't care about how hopeful people feel. It doesn't care whether you think the world is different now. It measures only one thing. And when short-term money becomes more expensive than long-term money, the message is never subtle. The present is unstable. The future is afraid of it. Who survives the reset? Not the people who panic, not the people who deny, but the people who prepare while the world is calm. Because every financial crisis has 2 timelines. The world before the breaking point. The world after the breaking point. And only one question matters. Which world are you planning for? You are watching this video in a rare moment in history. A moment where the warning is already visible, but the consequences have not yet arrived. That window doesn't stay open forever. There are only 3 kinds of people in every crisis. Those who never saw it coming. Those who saw it but did nothing. And those who acted before everyone else woke up. Only one group walks out stronger. The yield curve is not predicting chaos. It is giving everyone a chance to decide whether they want to be surprised by the future or ahead of it. History doesn't repeat itself, but it rhymes loud enough for anyone willing to listen.